Okay, so let's get right into it. We're seeing something really fascinating play out in the US right now. A real tale of two economies. You've got the markets hitting these incredible, record-breaking highs, but at the same time, there's this profound financial struggle happening for so many. This disconnect, it's a huge story, and it has massive implications for all of us.
I mean, look at this contrast. On one side, you have a booming stock market, right? Indexes are through the roof. Wall Street is celebrating. But then you flip that coin and you see a completely different reality. While the market's party is going on, a huge part of the country is facing some serious financial hardship.
So how do we make sense of this? Well, to really get a handle on where the market might be heading next, we've got to first understand this widening gap. Let's start by looking at what's really happening on Main Street.
So officially, the government says the poverty line for a family of four is just under $32,000 a year. But let's be real. For most people, the income you actually need just to get by, just to be stable, is probably closer to double that number. This chasm between the official line and the reality on the ground is putting an absolutely immense pressure on families.
So what's really causing this squeeze? Well, it's kind of a perfect storm. The cost of just about everything keeps going up. Housing prices in particular are just eating up a massive chunk of people's paychecks. And then, on top of all that, there's this growing anxiety about the job market. You know, that feeling that if you lose your job, finding a new one would be, well, pretty tough.
And this pressure, it's not spread out evenly across the country, not even close. It's really concentrated in four big states: New York, Florida, Texas, and especially California. I mean, in California, the high cost of living is so intense that it creates this huge financial strain, even for families that, on paper, have what looks like a pretty decent income.
You know, this massive gap between Wall Street's success and Main Street's struggles, it has not gone unnoticed in Washington. In fact, all the signals we're seeing suggest that a pretty significant response is in the works to try and help the real economy.
And this is the critical part. There's a consensus building. The focus seems to be shifting away from just propping up the financial markets. The new idea is to provide direct support to the non-financial real economy, you know, the part where most of us actually live and work.
And the message couldn't be clearer. The stated goal is to help Main Street. This points to a major pivot where government spending could be aimed directly at citizens and small businesses. And that, well, that could have huge ripple effects across the entire economy.
Okay, but a big policy shift like this doesn't just happen in a bubble. It's like throwing a huge rock into a pond. The ripples are massive, and the biggest ripple effect here has to do with market liquidity, which is basically the lifeblood of the whole financial system.
So, quick refresher, what is liquidity? Think of it like the oil in the engine of the economy. It's all the cash and easy-to-sell stuff just sloshing around the system, making everything run smoothly. When liquidity is high, markets tend to do well, but when it starts to dry up, that's when things can get really dicey.
Now, this is where things get really interesting. The Federal Reserve has made a major change. For a while, they were doing something called quantitative tightening, or QT, which was actively pulling liquidity out of the system. They've stopped that now. They've moved to a neutral stance. The key thing to remember is the Fed is no longer draining the pool.
In fact, the Fed is actually expected to start adding a little bit of liquidity back in. But, and this is a really important point, we are not talking about a massive fire hose of cash here. This is just a small technical adjustment to match the pace of economic growth.
So we're talking about maybe $200 billion a year. And look, I know that sounds like a ton of money, but in the grand scheme of things, it's a drop in the bucket. It's nothing compared to the trillions that were pumped in during the post-COVID quantitative easing. This is not a game changer. So, if the Fed isn't holding the keys to the liquidity car anymore, who is? Well, all eyes need to shift over to the U.S. Treasury. Right now, how the government pays for its spending is the single most important factor for the markets.
See, up until now, the Treasury has been issuing a lot of short-term bills to finance its debt. These are almost like cash, so this strategy has actually been good for market liquidity. But there's a big change on the horizon. A shift toward long-term bonds, which would lock up cash for years and pull it right out of circulation.
And boom, here it is. This is the phrase from a recent Treasury note that has all the market analysts on edge. They have explicitly stated a plan to issue more long-term debt. This isn't some minor tweak. This is a major bearish signal for liquidity because it takes cash out of the market and locks it away for a long time. All right, so let's connect all these dots. You've got a struggling Main Street, a government that's planning to step in and help, and a Treasury Department that's about to fundamentally change how it pays for everything. How does all this translate into a forecast for the markets?
Here's how this could all play out. Right now, things feel okay because the Treasury is still using that short-term debt, which supports liquidity. But as we get into late 2025, the government is probably going to need to fund some big real economy projects. Think infrastructure, energy, that sort of thing. And they'll likely do it with those long-term bonds. By early 2026, that shift could drain enough liquidity from the financial markets to create some very risky conditions, and potentially a major top for the market.
So why should you care about this? Well, this isn't just some boring government accounting stuff. Issuing long-term bonds cranks up something called duration risk, which could make the bond market way more volatile. But most importantly, the kind of liquidity drain this would cause, historically, that has been a huge headwind for stock prices.
And all this leaves us with one heck of a question to think about. As government money and support starts flowing directly to Main Street, could the smartest investment move be to follow the money? We might be entering a world where the best opportunities aren't on Wall Street anymore, but in the very parts of the real economy that it's ignored for so long.